David, are some of these fears right now, is there a sort of, I guess, some substance behind it?
I guess maybe the substance from an investor perspective just comes from all the uncertainty that's around these talks, and there's always uncertainty with these talks that happen every 4 years. But this year is a totally different ball game for a number of reasons. One of which is that the demands have been made public by the union in advance, which is unusual, but also that the demands are in some cases incredibly drastic and I see their perspective, but in some cases, I think they're unreasonable. In some aspects, they're not unreasonable either.
Well, I am curious. I mean, just on those demands, a lot of people made a lot about the 40% number that was tossed around based on various reporting here. And we know this is an opening salvo. I think what was interesting, I went back and looked at the past negotiations, and when you look at some of the starting points, this is way higher than where they even started in the prior negotiations in terms of percent increase in pay. And I'm curious as to why you think the union this time around felt comfortable enough, felt confident enough to make such a strong demand up front.
Yeah, for a number of negotiations, the unions have been dealing with the fallout of the Great Recession and the bankruptcies of two of the Detroit Three. I believe it was even in 2011, they weren't even allowed to strike at FCA and GM because of the bailout money from taxpayers. So they've sacrificed a lot multiple times. When you adjust for inflation, put the wages in real dollars, as UAW President Fain did in a video recently, the starting wage is drastically lower than where it should be. And you look at the profits being generated by the firms now; they're doing quite well. And I think the workers do deserve a raise. You mentioned the 40%. Honestly, I think the automakers can afford to do that. It's the other stuff like reopening the pensions, resuming retiree health care. It's just, unfortunately, it just doesn't look economically feasible.
And David, of course, there's a lot up in the air right now, as you just walked through. But assuming that the workers win here, what does this mean for the likes of GM and Ford when you consider their non-union rivals, such as Tesla, for example? What does this mean potentially for the competitive landscape?
Yeah, and that's a really key point here is what does the contract ultimately look like? Because according to your excellent auto reporters in Detroit, they came out with a number citing some sources of 80 billion in incremental costs at each of the Detroit Three. That number is just, to me, off the table. They cannot afford to do that because compared to 20, 30, 40, 70 years ago, you have so much more competition now. And some that hasn't even come stateside yet. All I hear about constantly is how good the Chinese automakers are getting. But Tesla is the cost advantage leader, and you have to do everything you can to keep your costs. I don't think you can get to parity anytime soon, but you certainly need to be competitive in that cost arena. And so adding 80 billion in costs, it just doesn't make any sense.
And David, we don't have much time left, but I agree our reporters are excellent. And I agree $80 billion is a scary number. But then you take a look at the stock market reaction, the big fall that we're seeing in GM, in Ford. Do you think that this is an overreaction, or is this well calibrated to this potential risk?
I think Wall Street hates uncertainty and they don't like fear, obviously. So I think the stocks are going to stay in the penalty box, so to speak, the investor penalty box for a few months at least until we see how this plays out. Do we have a strike? Is it a strike at all three or just one? And how long does that strike last? Because this is not a normal negotiation, which we could talk about quite longer.